The world's rapidly rising energy needs, electrification, the AI revolution, these are things creating demand for a whole spectrum of metals, many of which the world has never needed at this scale before. And supplying those metals responsibly, consistently, and at the right cost is one of the defining industrial challenges of our time. Sibanye-Stillwater sits right at the heart of that challenge. It is one of the world's largest producers of platinum group metals, a major gold producer, and increasingly a player in battery metals and recycling, with operations spanning multiple continents and some of the most strategically important supply chains on the planet. I'm Mobeen Tahir, Director of Macroeconomics and Thematic Research at Wisdom Tree, and I'm delighted to be joined today by Dr. Richard Stewart, CEO of Sibanye-Stillwater. Richard, welcome to the show. How are you?
Naveen, good morning. Very well, thank you. And thank you very much for the opportunity to be here. Very much looking forward to the conversation. So thanks so much.
We are excited to have you and looking forward to the conversation as well. Before we dive into Sibanye-Stillwater and all the things you do as a business, would love to introduce you to our audience, Richard. You have a PhD in geology from WITS and spent over 12 years rising through Sibanye-Stillwater before taking the CEO role not too long ago, I believe in October 2025. How has that scientific and operational background shaped how you lead the business, and what does it mean to you to now be steering a company of this scale?
Yeah. Naveen, thanks very much. I guess I got to say up front, listen, I've been very, very blessed and very lucky with my career. As you mentioned, I come from a technical background, geology in particular. I've also had the fortunate opportunity to work in R&D with some of the best minds in the world, to work in consulting, operations, and finance as well, private equity. I spent some time. So I've had a real uh, lucky career in terms of being exposed to all aspects of the business. And then, as you quite rightly mentioned, 12 years in Sibanye. I think the sort of technical background and geology in particular, um, where to me that sort of does shape my thinking is the ore body is the one thing in mining you can never change. So what you've got is what you have to mine. You can always come up with new engineering solutions. You can come up with financing solutions, but you can never change what's in the ground. So ultimately, that's the aspect of mining that dictates how you do everything, how you mine it, how you finance it, how you think about optimizing that extraction. And certainly one of the core pillars of our strategy as we go forward is something we call resource optimization. And that is all around how do we understand our ore bodies and make sure we extract them in a responsible but sustainable manner that maximizes that value. So I think having that understanding, of course, it's caught the value chain as well in mining. I've spent time in exploration, so all the way from discovery through to the last day where you close the doors on a mine, geology plays a role throughout. So in that regard, I think it is a great background to understand, being that so much hangs off of it. I think the 12 years coming through Sibanye, and that also gets very interesting because there I've been, again, very fortunate to work in the technical parts of the business, the commercial parts in business development, the M&A and capital raising financing, and then more recently in operational and general management, both as COO and heading up one of our regions. But I think the part for me that's probably most valuable out of all of that is the people. So we often talk about people in our mining business is 50 to 60% of our costs. We forget that people are 100% of our revenue. Everything we do is the people. It's actually a people's business. And I think that broad experience, what that really gave me an understanding of is the incredible people we have in the business, the culture we have, where people, what makes them excited, what drives them in the business, but also where our challenges are on a daily basis. And understanding that, I actually think, is what will be the real driver in how we lead Sibanye going forward. It's all about people. But of course, that technical background will certainly shape some of the what we will be driving in our business going forward. So I certainly consider myself very blessed with the opportunities I've had and have many people in my career to thank for that, including our predecessor, Neil Frodeman, who I took over from was instrumental in shaping that career. So I've been very lucky and blessed in that regard, maybe.
Very nicely put, and so refreshing to hear this idea that your people are 100% of your revenue in an era when we hear so much about cost cutting and AI taking over and all these things. You still recognize the importance of human expertise and human knowledge and input and creativity. Very refreshing to hear, certainly. Now, you mentioned resource optimization, fantastic term, and we will, of course, explore more of that idea through this conversation. But for investors who may not know Sibanye-Stillwater well, I know many investors do know it as one of the biggest miners in the world. But talk to us about the business today, a big overview, the big picture, the metals you produce, the geographies you operate in, and what makes Sibanye-Stillwater distinctive in the global mining landscape.
Oh, perfect. Thanks for being. So I think let me start off maybe with the metals. So I mean, predominantly today we're a precious metals producer. So certainly where we are today, 99% of our revenue and our earnings comes from precious metals, being gold and platinum group metals, which I can unpack in a bit more detail. We have then also recently completed a project in Finland, a lithium project. So that we are currently bringing online. So that will certainly contribute to the mix going forward. And then we have a small zinc operation in Australia, which has got about a year's worth of life left to it. So that's small and coming to the end of its life. So those are the key metals we produce. The big jurisdictions we operate in, South Africa is our biggest, both gold and PGMs in South Africa. The US is a key district on PGMs, and then, as I mentioned, Europe for lithium and Australia zinc. I think what possibly distinguishes us a little bit is as you mentioned, we don't just produce metals through primary mining. We actually have a strategy that we call a resource stewardship model, which we can unpack in a bit more detail. But that recognizes producing metals from three different pillars. So there's primary mining, there's what we call secondary mining, which is mining old waste. So it's really tailings facilities, old dumps, etc. And then we have recycling. And on the secondary mining, there we do a lot of gold and PGM secondary mining. And Australia zinc is actually an old tailings mining facility. And then our recycling business in the US is quite significant. So that started as platinum only or PGMs only, and has now expanded into other precious metals as well. So we've got the different legs to it. So to try and summarize that, I think what does distinguish us is these three pillars of how we supply metals. It's not just primary, but secondary and recycling. But the core metals today, precious metals, as you mentioned, diversified into batteries and based in Southern Africa, Europe, and the United States, with a small footprint in Australia.
Very, very thorough overview indeed. Let's unpack some of those things in turn and start with the big one, of course, platinum group metals, PGMs, and precious metals. We've noticed some people recognize the importance of course, gold is one which is perhaps most well understood in the world of financial markets. Platinum group metals, relatively smaller and perhaps less understood. There's so much industrial application of platinum group metals in catalytic converters. And more recently, we've even seen a lot of interest for platinum, particularly uh, coming from the data center economy and hydrogen fuel cells, and the idea that a hydrogen fuel cell could actually power a data center, with companies in the US particularly um, creating that use case. And hydrogen fuel cells often use platinum, and that is a very fantastic industrial emerging application of a precious metal. So, talk to us about, from your perspective, the importance of platinum group metals in the overall economy. Um, what do you think are the most important uses? And talk to us about the applications, whether it's industrial, whether it's elsewhere. How do you see the landscape evolving for PGMs and precious metals in general?
Mm. They truly are fascinating metals. It's a fascinating market. So although they are probably the rarest or most precious of all precious metals, They are very much
Mm.
industrial, and that makes them quite unique. Well, let me first start with what are platinum group metals? You've mentioned platinum. That's obviously the one that's the most well-known and most common, but there are actually 6 in total. So there's platinum and palladium, which are the 2 most common ones. There's rhodium, and then there are 3, which we call the minor metals, and I'll explain to you how important these are becoming, which is iridium, ruthenium, and osmium. So if we just start off with the PGM market to put the size into perspective, gold today, which we think is a precious and rare metal, and certainly it is. The gold market, we mine about 120 to 130 million ounces per year across the world. PGMs on an annual basis is less than 15 million ounces mined. So it's 10% of the gold market, just to put that into perspective. And that's all 6 of them. If you look at just platinum alone, for example, it's about 5 to 6 million ounces. So these are very, very precious metals. They get used in a whole host of different applications. Obviously, the biggest one that's well known is in car auto catalysts to essentially control exhaust fumes. And today that accounts for about 70% of applications. So about half of platinum, most of palladium and rhodium going to that one use. But the other industrial uses are diverse. So platinum is probably one of those few metals that you might be wearing a wedding ring today. That will be platinum. You get into your vehicle, if it's a internal combustion engine vehicle, you've got platinum in the exhaust pipe. And then around the corner, somebody will be being treated for cancer with platinum as part of their treatment cure. So these are diverse, precious, and really well utilized metals. Some of the minor metals you mentioned, something like iridium, that gets used in every spark plug. For anybody who uses a screen with touch glass, that gets produced in a crucible that is an iridium crucible. So you cannot have touch screen glass today without iridium. Yet these are tiny markets. So these are really critical metals to the way we live today. And one of the most exciting ones recently has been ruthenium, which very few people know about, but is critical in hard disk drives. So with the advancement of data centers, ruthenium is one of those metals that's gone up more than 5 or 6 times in the last year, given the demand in data. So these are metals that, although we often associate them just with vehicles, actually have a very wide range of applications. And that's what makes me so excited about them going forward. And the reason for that is they have unique chemical and catalytic properties. So the opportunity to find new demands in the new world we're heading into, I just think is immense. And that's obviously a lot of what we're doing. Also quite uniquely is they're only really produced in South Africa and Zimbabwe, so Southern Africa, Russia, and a little bit of North America. So Montana in particular, which is one of our operations, and then a small amount in Canada around Sudbury. Most of that actually comes out as a byproduct, as a consequence of nickel and copper mining. So not only are these very rare and precious, but they actually come from very few areas in the world. So they are truly fascinating metals. And to your point, I think one of the biggest demand outlooks is for the energy sector, specifically around hydrogen, both in the ability to produce hydrogen, but also in fuel cells as energy generators. So very exciting metals with I believe, a very exciting future.
You mentioned the wedding ring. I am indeed wearing one, and it's fascinating, the breadth and scale of the use cases, from jewelry to industrial applications for these things, and very very interesting. You mentioned the minor metals as well. No pun intended. I imagine that pun often comes up, minor with an OR or an NER. I'm curious though. You mentioned how some of these are mined as byproducts of, say, copper and nickel, like you mentioned. Is that generally the case where a mine, especially for PGMs, is a PGM mine, and you have maybe all 6 or a few different metals coming from one location? Is that generally how it works, or you have independent mining for all of these metals separately?
Mm. Yeah, it's a very interesting question, Murray. So in South Africa, we have primary PGM mines. So that is the primary production. And here we mine all 6 metals. So that is where all 6 come from. We are slightly weighted towards platinum compared to the others coming out of South Africa. But primary mines mining all six. And one of the important points about that is you can't target one or two of these metals. All six come out together in a certain basket in a certain amount. You can't go and mine more platinum and less palladium or something like that. They all come out together in a certain basket. In Russia, in fact, most of the palladium is mined very closely with nickel. So they are almost equal value, so you can decide which one is primary and which is a byproduct, but that's mined very closely with nickel. And in Canada, it's largely been a byproduct. So our mine in Montana in the US is the only primary palladium miner in the world, outside of South Africa, where it comes with a basket. So these are very, I want to say, unique metals that 70%, 80% of platinum comes from South Africa. So that's where this comes from as a primary mine. But it's very difficult to go and target these individual metals mining across the world. They come out in a basket in a certain ratio, and that's almost how we have to manage this market going forward. Which also makes it very interesting from a market dynamic and a balance perspective of demand for these various metals.
That's so insightful and helpful. As an investment house at Wisdom Tree, we show our investors the exposure of any miner to the underlying commodities. And we see that it's never 100% exposed to just one commodity. In most cases, you have an exposure to multiple commodities, and we show that breakdown where that data and visibility exists. But you offering that color really provides a lot of context and explanation for why and how that is the case. You painted a very good picture for the PGMs and the use cases ranging from jewelry to hydrogen fuel cells. Would love for you to do something similar for the more traditionally industrial or base metals, as we call them. We've mentioned a few. We've mentioned nickel, copper, zinc, lithium in our conversation already. Of course, all metals used in things like renewables, electric vehicles, but paint a picture for the base metals or the industrial metals, if you like, that are in your portfolio, their importance and where they sit within Sibanye-Stillwater's business, and why investors should be paying attention to these commodities.
Mm. So I mean, I think in terms of our particular portfolio at the moment, we actually produce copper and nickel in particular as a byproduct of PGMs in this regard. So we don't do any primary copper and nickel mining. Um, so for us, certainly from an investment perspective at the moment, it hasn't been a core part of our focus over the past few years, and we just get exposure through that byproduct exposure from PGMs. I think when we look forward, obviously the lithium's a slightly different story, but we can come on to that. I think certainly when we look forward, and I think why investors need to be paying attention to this is, as you quite rightly mentioned, I think up front, you actually made the comment, we're getting a lot of AI and new applications, new demand that's driving metals. And for us, one of the core there is energy. And we really look at what are the metals that are going to be critical for energy going forward, and there's a way we think about that, hence the battery metals. But in that regard, we do have some projects within our portfolio. For example, we have a copper project in Australia. That's something we've been looking at closely and assessing. But as it stands today, those metals for us are largely byproducts, with our focus that's been on precious metals so far. So I think these are critical metals to think about from an investor perspective, but for us, it's largely been byproducts to date.
Makes a lot of sense. And you mentioned how energy is such an important part of the overall picture. We in some of our materials in our slide decks, we use this chart from the International Energy Agency, which compares the metal intensity of different sources of energy. So if you want to produce 1 megawatt of electricity from coal, you require about 1,000 kilograms of different metals. But if you want to generate the same 1 megawatt of electricity from offshore wind, for example, you require 15,000 kilograms of metal. So 15x increase in renewable energy as far as metal demand is concerned versus fossil fuels. EVs have a similar picture, 2 to 3 times more metal intensity for various metals compared to internal combustion engines. Now, you've mentioned AI, data centers, all these exciting sources of demand. As a business, does that give you a lot of visibility over the long term trends that will keep the demand going for the stuff you produce? What does it really mean for Sibanye-Stillwater to have these trends on the ground that possibly give you comfort that look, what we're doing is important, it's going to only go up in the years to come? What does it mean for the strategy and you as a leader?
Yeah. I mean, great question, because I think it really goes a lot to, a couple of aspects, and that is, how do you want to position yourself in terms of the metals you're going to produce? I think in today's world, as we've seen with all the geopolitics, etc., it also comes into where and how are you going to produce it, not just what. And ultimately, that all comes down to capital allocation decisions. I mean, if we bring it back down to the pure business piece of it, so I think as mentioned, for us, the big mega trend we look at is energy. Because I think no matter which way you look at it, whether you're talking AI, whether you're talking data centers, it's all going to require more energy. When you think climate change, heating, cooling, growth in middle class, that's going to require more energy. And whether you subscribe to the energy transition story or not, the fact is we're going to run out of fossil fuels at some point. They're finite, and that's going to require more renewable or different forms of energy. So no matter which way you look at it, energy demand's going up. The type of ways we generate energy is going to change, and therefore, there are new metals needed for generation, for transmission, and for storage, and all of those come with different metals. So certainly the way we look at it is to try and say, what are the big trends there where we have some form of competitive advantage that we believe we can leverage, of course, and add value to, and what's got some sort of stable outlook, and therefore, how do we think about capital allocation in those forms? So perhaps if I can just give you some examples, I mean, that's how we got into battery metals and lithium. So we already produce platinum group metals for OEMs, for automobile OEMs. They're our biggest customers in that regard. We saw the electrification of vehicles and recognized that in particular, some of these metals for batteries were going to be scarce. So how could we now offer a different product to our OEM customers, not just being the precious metals they needed from PGMs, but also the battery metals as they evolved with the electrification of cars? And I think what you can sort of hear, and then from there, we looked at Keliber lithium, and ultimately that was part of the rationale behind building that. Now, if I just unpack all of that and how strategically it fits together. So there's an aspect of what do we produce, looking at a mega trend, energy storage, automobile electrification. That's how we landed at lithium. I think you then need to think about, well, where do you produce it and how do you produce it? Lithium is quite a common mineral. You can produce it anywhere in the world. But today, most lithium that gets produced simply goes to China, is processed in China, and then goes into a supply chain. So as a miner of lithium, you essentially become a contract miner for China, and you're exposed to the markets and whatever prices that is. By setting up in Europe, and specifically not only mining, but also going all the way through to beneficiating to a final lithium product, allows us to integrate directly into the supply chains in Europe. So now we can provide battery metals into the supply chains within Europe and the automobile supply chains there, which becomes a completely new differentiator that I don't think the mining industry's looked at before. Historically, it was just a cost game. Now you actually start looking at how you produce it, where you produce it, what supply chains you can integrate into, and that can give you a lot of different competitive advantages and differences. So lithium is an example of a really good market where I think we could understand strategically why that was the metal we wanted to get into, where we were going to get into it, and how we were going to get into it. And then from a capital investment perspective, there it was a greenfields investment. So, happy to invest in a commodity that we see long-term, strong demand for. This is not a short-term cyclical thing. batteries and lithium as a core underpin to batteries is going to be around for decades. So that was a new big greenfields investment. If we take something like our PGMs at the moment, we think PGM demand, if you look at big cycles, long-term cycles, for the next 10 years are going to be pretty stable. It's still going to be underpinned by internal combustion automobiles. Beyond 10 years, there's a bit of a question mark as to how demand plays out. I think we see a lot of opportunity with hydrogen. We see a lot of opportunity with other industrial demands. But exactly the pace at which that takes up, how quickly it comes in, what that technology looks like, is a little bit more difficult to forecast. So investing in new greenfields projects in something like PGMs today is a bit more of a difficult decision, I would argue, from our perspective, from a capital allocation, because where exactly is it going to be? However, that's where we've got assets today that have got incredible brownfields opportunities. So that is relative low capital intensity within our existing projects. And if anybody has listened to our Capital Markets Day presentation that we gave a few months ago, we spoke a lot about the brownfields investment opportunities that we have in our South African PGM operations. And this is how that fits into those sort of big mega cycles. So it's slightly less of a bet on huge capital new projects, but we have brownfields opportunities to continue to invest. And this is the way that sort of thinking, is almost driving our ultimate capital allocation as a business. So what are we going to invest in? Where are we going to do it? And how are we going to do it? And the same thesis holds for recycling, which we can unpack in a bit more detail, but it's a different way of getting a supply to deliver into these new markets.
When you say brown fields and green fields, would love for you to just elaborate on those terms and what exactly they mean.
Good, Graham, great question. Yes, so greenfields effectively being projects that you're building from scratch. So if we take Keliber as an example, we acquired Keliber as an exploration project. So there was nothing existing at the time. And effectively, we built up from scratch a mine, a concentrator, and a refinery. So it was built with nothing there. So, of course, a lot more capital. That comes with, in terms of a new build, obviously a lot more risk just in terms of the time and the amount of capital that comes. But you're effectively starting it from nothing. I think something I have to say about Keliber that we're very proud of is and this is certainly, again, when you're thinking about supply in the new world going forward, when we looked at Keliber, there were 5 lithium projects in Europe that were all at the same stage, exploration ready to go into build. Today, there's 1 that's been built. The other 4 still remain at an exploration stage. So although there's a lot of these projects out there, the ability to actually build them and get them into production comes with its own challenges, and we can touch on that. But Keliber's been a big success of a greenfields project where we started essentially from scratch. And that, of course, is a lot of capital. So Keliber as a project was over 800 million euros to build it. Brownfields in South Africa, we have all the existing infrastructure in our existing mines. So we already have underground infrastructure. We already have all the processing capacity that we need. We already have all the people and the systems that we need. And this is about, on our existing mining footprint, recognizing areas where we can either expand or continue to mine new areas that we hadn't previously identified, but effectively using all the existing infrastructure and all the existing systems that are in place. So your relative risk is much lower. Your relative capital cost is much lower to be able to build those. And therefore, from a capital allocation perspective, it just comes with a completely different risk profile. And that's where I think we are quite unique in the PGM industry, is a lot of our growth opportunity or extension opportunity is brownfields, so very low risk, compared with a new greenfields project. But where commodities are in their relative cycles certainly informs our thinking around how we think about capital allocation for that, given that mining is a 20 to 30 year investment game.
20 to 30 year, and I do want to ask you about timelines, because that often comes up in our conversations whenever we talk to investors about strategic metals mining in general. But the Keliber project specifically, I think let's explore that a little bit further, because You mentioned the only project that actually is out of the five that went through, and the one of the only few mine to market lithium projects outside China, very strategically important for Europe. I know as a miner, you probably need the the buy-in from local communities, right? That you want to mine a certain mineral in a certain geography. Uh, you mentioned how there's there's a strategic importance for countries to build their own supply chains, the dominance of China in so many different minerals. How did those conversations with Finland and in general with European governments and policymakers evolve, and how did that come about, and what was the receptivity and support that you received from policymakers to mine lithium in Europe?
Mm. Maybe good, great question. And perhaps I can start off with the sort of mining piece because you're 100% correct, particularly mining in Europe. I think is an area where there is a lot of permitting, sometimes a lot of resistance from local communities, etc., to mining in general. Um, and I think that this is somewhere where, you know, and I guess here talking from an investor's perspective, looking at a lot of these projects through an investor's eyes, we so often hear about how many projects there are, how much supply is going to come online, how quickly it can come online if the prices are right. But we often forget about the challenges, as you've quite rightly mentioned, to actually bringing these projects online, be it permitting, be it support from communities, etc. And Caleb is a great example of a project that is not necessarily the biggest project in the world. It's also sort of mid-range or on the cost curve, so it's not the cheapest project in the world, but it's a project that we could build and get into production while others would take a lot longer. And the reason for that is there's several parts to it, but one is it's not so much in an environmentally sensitive area, so that is one aspect. It's actually on an old peat mining footprint. But the other aspect is a very supportive, not only government in Finland, in that they have a strategy around a battery metals value chain. So they support very much the upstream mining of the metals that go into that. But very interestingly as well, in Finland, I think we've actually seen huge support from the communities around us, partially because they recognize the good of electrification of vehicles going forward from an environmental perspective and recognize that you cannot achieve that without producing the metals. So the fact that we're mining metals that are going towards a green solution in their ultimate product has actually got us a lot of support for that mining in Finland. So we've been very lucky in that regard. I think that that's part of the reason why we targeted this asset in particular, and that's why we've been able to bring it online quite quickly. I dare say that's not going to be quite as simple and easy for many of the other projects that don't have those benefits. Um, Generally, in terms of the support that we've got from Europe, and there you're quite right. So we very intentionally built what we call a mine to market project. We could have just been a mining operation and essentially sold um, that ore to China for processing, but we very intentionally built the refinery as well so that we can produce a final product that goes straight into the battery supply chain. And the reason for that is less than 30% of total lithium processing capacity in the world sits outside China. They've got more than 70%. And this is the only project of its kind in Europe. So from a strategic perspective, I think as the world is recognizing that it needs to diversify its supply sources from single source countries, and China in particular for many of these metals, so we offer a bit of a solution to Europe for that. We certainly are a homegrown opportunity to diversify away from China alone. And I think there we are getting strong support for that. We are still engaging with the EU to understand commercially, what that could mean and how they could assist us in terms of protecting that asset to price volatility. But overall, I think strategically very well positioned. And our engagements with the EU and local stakeholders has been very positive in this regard.
Okay, so a lot of policy support from the governments, the policymakers, and that has enabled you to bring this project online very quickly. But we often hear this idea, and you mentioned green fields and brown fields and the different timelines associated with the type of project it may be. We often hear this narrative that when it comes to mining, a new mine can take 10 to 15 years, depending on the metal, whether it's a green, I imagine whether it's a green fields or a brown fields project as well. But that is an important central narrative in this whole story, because we often hear this narrative that supply will always play catch up with demand. Demand creates the incentive for miners to mine more of these things, but it takes time to bring new mining online. And therefore, that creates that structural case for investors that you've got all this demand for data centers today, electric vehicles today, renewable energy today, but it will take many, many years to mine more of these minerals, and that is why there will always be a catch up, that supply will be playing with demand. That, of course, is a good thing for miners, because that creates an incentive. Prices get pushed up, and that creates an incentive to invest in projects like Caliber, which, as you mentioned, substantial investment. But you only do that when you have visibility of the long term underlying trend. Talk to us a little bit about that dynamic, that this idea of uh, the ground reality, quite literally, that it takes time to bring new supply online. And is it really the case that demand creates the incentive and then supply follows?
Yeah. I mean, absolutely. It's a very interesting cycle that you're referring to, and I think you almost need to look at it quite differently for different metals. So if we think about something, and again, let me use lithium and PGMs as an example, and then some of the critical metals. So if we look at something like lithium today, certainly our view is that that's got a long-term, fundamentally strong demand outlook. And therefore, we generally do see tailwinds in that regard, and prices almost incentivizing new supply to come online. I think one of the sort of critical aspects that's impacted that, of course, has been because China is such a big player in the market. They have also managed to almost control what that supply and demand dynamics looks like in the short term, and therefore impact prices. But in the longer term, that overall demand across the globe, we think, is going to drive higher prices. So there, for example, I think today that is an incentive for new supply to come on, and that's exactly what we've done with something like Calibre. I think when you look at something like PGMs, that's where it gets a little bit more tricky, in that the 10-year outlook is a bit less clear. So although we get short-term cycles where we get much higher prices coming on, and structurally that is a good support, is it enough to necessarily drive new projects coming online? That's a bit more difficult decision to make because of that 10 to 20-year horizon I mentioned, in order to get a return on a new project. Now, in markets like that, that's fantastic tailwinds for established producers. And this is why I say I think our positioning as an established producer with very short-term brownfields projects we can turn on quickly becomes very advantageous in those type of markets. I think where it gets really interesting is when you start talking many of these critical metals that are very short or very small markets, and are often supplying technologies which could have life cycles that are a lot shorter than what the mining life cycle could be. And in those cases, I think how that's going to get managed is something that still needs to play out, and how investments is going to be managed. And we're seeing it, I think, with a lot more government interventions to try and give some security to supply, to manage some of these very small and unique metals. And for us as a business, the real opportunity there is where the recycling leg comes in, because that is where you can try and get exposure to these metals without the significant capital investment and risk. But through a different means, you can still get the exposure to the metals. So certainly, I think these are definitely, it is definitely, as you say, demand does create tailwinds given the time to bring supply on. From a primary supply perspective, I think you need to understand the metal and the type of cycle you're in, and that will drive your investment. And for us, that's a variation from greenfields where we think there's long-term demand to brownfields where the demand is a bit more stable in the shorter term to recycling where actually that demand is going to be very volatile. That's a way to mitigate that risk. So part of our when I spoke about our resource models with the three, not only is that about a responsible way of supplying these metals, but it also gives us a way to think about how we allocate capital and mitigate risk for these different metals, depending where you are in the demand cycle.
That makes a lot of sense, and I like how recycling keeps coming back in the conversation. And you've mentioned the idea of resource stewardship and supplying these things with responsibility. Uh, would love to hear a little bit about the opportunity you see in recycling, because we see that recycling rates vary depending on commodity again, right? We often hear that all metals are recyclable, but the percentage of supply that comes from recycled metal is different depending on which metal you're looking at. Would love for you to share your perspective of the on the recyclability of all the metals that you produce, and indeed the opportunity for you as a business there.
Mm, absolutely. So, I mean, I guess when you think about sort of the recyclability of metals, at the end of the day, it comes down to two things: the technical difficulty of recycling it, and then, of course, the cost. So, can you make a margin based on metal prices? And that's again a supply dynamic of primary versus recycling. But the way we think about recycling, I think, is almost on two fronts. So the one is from a strategic perspective, and from a responsibility perspective, and then of course the business side. So ultimately, in our minds, when you think about a strategy, historically, I think mining companies have often sort of just been thought of primary mining, extractive companies. That's how you supply metals. We think that dynamic's going to change, and it's about how do you supply metals responsibly. So if you can supply them with a lower carbon footprint, with a lower cost, more quickly, should be the first metal that you supply. Primary mining should be the last metal that you supply to fill the gap. And that's how we think the metals markets are ultimately going to evolve. So to be exposed to recycling for us is a very strategic aspect in that regard. Of course, it needs to also make business sense. And this is where I think it's getting very interesting at the moment. So certain metals you can extract economically viably. And one of the real opportunities that it gives you is that in countries like today, where we are seeing scarcity of supply, they want to protect their own supply chains, but do not have minerals on shore. So they cannot build out their own supply chains. One of the ways to get access to that security of supply is through recycling. So it's becoming a very strategic supply as well. Now, of course, all that comes down to can you do it economically viably? And I think that's where the business we're building it has got such a huge strategic opportunity. And much of that comes down to the skills we've got, the systems we've got, the way we're understanding the market. It's an entire business that is quite niche and very strategic, I would say, moving forward. Purely from a numbers perspective, it also has a very different economic approach to mining because it tends to be a margin business. You tend to buy your scrap material, and that purchase price of that material is linked to commodity prices. So it tends to be more of a fixed margin business compared to mining, which also gives it a very different flavor in that you've got slightly less exposure during very volatile times to higher commodity prices and higher margins. But of course, during low times, that margin remains more consistent. So it gives you a great underpin to your business. And today we have a business that's running at very healthy margins and contributing very significantly to our earnings. So for us, this is a business that's not only responsible from a supply perspective, it's very strategic in terms of delivering some of these critical metals that are difficult to obtain, but it also makes great business sense. So overall, a very important part of the leg of our business that will continue to evolve as we move forward.
Something else, Richard, that always fascinates me when it comes to mining businesses, when you see these images and videos, these are just enormous operations. Some of the, like, even the trucks you see taking and transporting those minerals on these mines, you don't see them on the roads, right? The machinery that is used in these operations, incredible, very different. I'm curious because you mentioned how OEMs, the automakers are some of your biggest customers. You hear about automakers now buying humanoid robots, and you have robotic arms and quadrupeds and all sorts of automation to make the humans more efficient on the factory floor and so forth, to produce more cars uh, uh, p- per day and so forth. I'm curious how technology is evolving your business, especially you mentioned your people are 100% of your revenue, but technology often makes us more efficient and enables us to do a lot more. I'm curious, from a mining perspective, you've been in Sibanye-Stillwater 12 years, and you've studied and known the industry for a lot longer than that. I'm curious how you see the role of technology impacting a business like Sibanye-Stillwater in recent years, and what are the big trends coming forward?
Yeah. I mean, and I think we're living in absolutely fascinating times from that perspective. I do also need to start with a quote that I heard the other day. I think it was from Bill Gates, but I would check that. Who said, you know, we normally significantly overestimate the impact that technology will have on us in the next 2 years, but we significantly underestimate the impact it will have over the next 10 years. And I think that is very, very true to us in mining as well at the moment. I think so many of these technologies that are coming in, we're still getting to grips with what it actually means. And the very short term impact, I think, is we're just starting to explore that and will probably be limited. But over the next 5 to 10 years, I think it could reshape the way that we think about this. So for us as a business, I think it impacts different mining in different ways. When you are one of these large mechanized miners, as you've mentioned, big trucks, big open cast pits, which is normally commodities like iron ore and copper, there I think the opportunities to automate, etc., is huge. For us as being a more conventional operation, we've got some places where that exists. So one example would be our US mines, where we are certainly automating more and more there to increase productivity. So exactly as you say, this is not about replacing people, but it's about making people more productive. And in an environment like the US, where labor costs are very expensive compared to the rest of the world, to make people more productive is critical in order to make those operations more competitive and increase your margins. So there it's got a direct impact. And a big part of our strategy in the US today is about higher mechanization, higher automation, and ultimately how we can make people 30 to 40% more productive and efficient than they are today. So there it's got a direct impact on how we're thinking about mining. I think when we come to something like our South African operations that are very people intensive, the infrastructure we've got is a big backbone. So to try and fundamentally change the way you mine that is a lot more difficult. But this is where systems like AI and what we call digital twinning is becoming a huge area. So just to give you a practical example of what I mean by that, essentially what we're running in South Africa is huge logistical operations. So we put 10,000 people down a single shaft underground every day. And everything down there, from power and water and equipment, all needs to be supplied. So these are huge logistical operations. And when you can start building a digital twin of your operation and then use AI to help you say, how do I optimize these logistics? How do I optimize energy? How do I optimize schedules? How do I optimize, well, everything? Suddenly you start seeing how that can become a real enabler, again, to efficiencies, to cost savings, to productivity. And that for me, again, is something we've certainly started doing, and I would argue just scratching the surface of, but just the impact it's had on our energy demand is heading into double-digit figures at the moment, which in today's environment is a huge cost saving for us, and I think we can take it a lot further. So very different ways that I think technology is being applied in different areas. I dare say, I think the rapid changes people think we're going to see in the next couple of years is probably overestimated, to go back to my starting quote. But the impact this can have over the next 5 or 10 years, I think we're going to see companies leapfrogging each other, in terms of competitiveness, those that embrace this new technology and really move forward with it. So for me, very exciting times in that regard, but very much horses for courses, depending on what type of mining you're doing and what technologies could be applicable in those areas.
Very well put. And I love that you mentioned the idea of digital twins. So exciting to see a use case in your business of that innovation. Richard, as we bring the conversation to a close, would love for your final remarks on this idea. You've often talked about Sibanye-Stillwater evolving from being a mining company to a modern metals business. So let's bring the whole conversation together and get your thoughts about what it really means to be a modern metals business, and why is that expression important to you, and what excites you most as you embrace that expression, that term, and be a modern metals business for the future.
Yeah. Yeah, I mean, that's a great one, 'cause it does sort of bring it all together, I think, in many ways. So, in my mind, if you think back on a mining company perhaps a few decades ago, and certainly mining had the reputation of being an extractive industry, often a dirty industry, not leaving behind a good legacy. I don't think that was always the case, but clearly we do have a history in that regard of being extractive. I think when you look at where we are today, both through expectations from society, I think through expectations from business and ourselves, a lot of that's changed. I don't think we're simply the extractive industry we used to be. We recognize today things need to be done responsibly, and certainly, you have to leave your mining environments and your communities and your stakeholders ideally in a net positive, but certainly not in a net negative position. So that responsibility has crept into the way we operate today, whether it's ESG or various other aspects of mining. That is what I would say is a mining company today. I think there's a new level that's coming to that. I still think even in most mining industries today, it's still about how we can extract metals as efficiently as possible, but done in a responsible way. I think moving forward, it's not just going to be about how can you extract it as efficiently as possible. That's always going to be a core aspect of it. But how do you extract those metals? And that talks to all stakeholders. It's going to be about how you integrate with your downstream suppliers. It's not just going to be extraction onto exchanges, but who your actual suppliers are and how you manage those demand and supply balances. And then ultimately, the actual method you produce these metals. So this is where the recycling becomes critical. That to me should be the first metals that get produced. A recycled PGM ounce has got about 100th of the environmental footprint, whether you talk water, energy, rock waste. It's got about 100th of the size of the footprint as a primary metal. You have to go after that first if you're going to be responsible, and then fill up with primary. So I think a modern metals company to me companies are going to have to evolve. It's not just going to be about extraction at the lowest cost, but it's going to be about how you produce these metals and how you ultimately integrate into the supply chains downstream and be seen as part of the value chain as opposed to just a supplier of an upstream product.
Very well put. And at this point, I have to bring the conversation to a close. But before we go, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of Wisdom Tree and in this episode, Sibanye-Stillwater, and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. Richard, what an absolute pleasure it was to have you on the show. Thank you so much for joining us.
Wonderful, Mobeen. Thank you very much for the opportunity. Appreciate that.
And thank you to all our listeners and viewers. We hope you enjoyed this episode of The Next Big Thing. And of course, if you want to hear more from us, subscribe on whichever platform you're using. Check out our website and follow us on social media on LinkedIn or X and learn more about megatrends. And of course, stay tuned for the next episode. We'll see you then.